Chapter 7 covers the Sarbanes-Oxley Act, internal control, and special situations we may come across with cash. So first we're going to talk about the Sarbanes-Oxley Act, which was passed in 2002, and how it's changed accounting and their internal controls. It applies to companies whose stock is traded on public exchanges. So these are companies that you could go onto the stock market yourself and trade those companies. There are also privately owned companies. This does not apply to privately owned companies. The Sarbanes-Oxley Act is to restore the public confidence and trust in companies. This stems from Enron. You may remember that company. Basically what they did is they lied on their financial statements to make them look like they were in a better financial situation than they were. People invested in them and lost a bunch of money. So that's why the public companies have to follow the Sarbanes-Oxley Act, so that public people who don't know the internal runnings of the business can be protected from fraud in investing in the companies. It requires that companies maintain strong and effective internal control, and we'll discuss what that is. It's broadly defined as the procedures and purposes used by a company to, first of all, safeguard its assets. With internal control, we're controlling our assets that we have in the business internally. Internal control also helps us process information accurately. It gives us the procedures so that we collect information and distribute it where it needs to go and keep records the way we need to. It also helps us comply with laws and regulations that the government sets forward for whatever type of business we're in. So here's an example of a Sarbanes-Oxley report for Nike. So it's reporting about their internal control and financial reporting. I'll take a second and let you read that. So if you take a look at it, what it's doing, it's talking about who's responsible for controlling or doing the internal control. It also shows that PricewaterhouseCoopers, which is a very large accounting firm, is actually doing the accounting for the company. They contract that out, which is very common. They've audited the accounting papers to make sure that they are correct, and they've double-checked them. So this shows the following Sarbanes-Oxley Act and what they've done to comply with that. Next, we're going to describe and illustrate the objectives and elements of internal control. So again, we want to safeguard assets, we want to make sure we have accurate information for our financial statements, and we want to make sure we're following the laws and regulations that are set forth. Employee fraud is something that we have to worry about with internal control. That is when an employee intentionally, on purpose, deceives an employer for personal gain. So you're lying to the company, you're deceiving the company so that you make some sort of benefit out of it. So there are 5 elements of internal control that we're going to discuss. The elements are going to help us meet those 3 objectives, again, safeguarding assets, having accurate reports, and complying with laws and regulations. So the elements that are going to help us design our internal control, and these are going to come up in an activity, so pay attention, are the control environment. So what environment do we have set up so that those internal controls can be successful? Risk assessment. Are we assessing what might happen that's wrong and preparing for that? Control procedures. What do we do specifically to control our different assets? Monitor. Who's in charge of monitoring and overseeing it? And then also information and communication. What information is shared with whom and how? Here is a graphic demonstrating the elements of internal control. At the top you have control threats that are bombarding the business. You'll see that monitoring will block those from reaching down into the management and stopping those threats from happening. You have risk assessment and control procedures that are going to stop it from moving down into your information and communication, and you have your control environment, which is going to stop it from moving down into the business. So control environment is the overall, like I said, overall attitude of the management and employees about the importance of control. So what kind of environment is set up? Is it an environment that is stressing the importance of internal controls, and is it going to make it a successful program? So what affects the control environment? Well, first of all, the management. So their philosophy and how they operate. They're the ones who are in charge. They're the ones who set an example. So depending on what their management philosophy is, their philosophy on internal control and how they operate is going to influence the control environment. Also, how the company is organized. The company's organizational structure will make a difference. The more levels you have to go through, the more diluted messages get. So that can make it harder to control the environment. People become more anonymous. So if they are doing something they're not supposed to, it's not as easy to catch them. So that organizational structure comes into play. And finally, personnel policies. Depending on the rules about hiring, firing, dealing with employees who are doing things that are wrong, that's going to also affect the control environment. Again, here's a graphic just demonstrating the control environment. You have the CEO or upper level management. Their philosophy and operating style is what's going to be passed down to all the other employees. The organizational structure comes into play here. As it's passed down, how far does it have to pass? How many levels does it go through? And then we have an HR, human resources manager, developing the personnel policies. So how are we going to handle employees if something does go wrong? So some control procedures we might have are to have competent personnel knowing what they're doing, rotating jobs so nobody gets too comfortable in one position and knows how to trick and lie through it to do some employee fraud. Changing duties, kind of the same thing, and mandatory vacations. You make people take time off so they don't get lazy, they don't get tired, they don't make silly mistakes. So you can help that with the personnel procedures. Also, separating responsibilities for related operations. Having more people involved in a related operation means more people to check each other. You also separate operations, custody of assets, so separate who has which assets, who's in charge of which different maybe petty cash accounts, and we'll talk about what that is. That's spendable money for the company. Have multiple people in charge of accounting. If one person is responsible for any of this, they can hide things and not tell the company and steal from the company. Also, proofs and security measures, and we'll see a graphic shortly about how that can be done from a sale all the way to putting the money in the bank. Again, a graphic. We have our control threats. Here are a bunch of the control procedures we mentioned, protecting management and the business from those problems and taking care of internal control. Monitoring, which we discussed, is looking for weaknesses of the internal controls and trying to improve the controls. So we watch it, we monitor, we see what happens. We say, oh, this isn't working so well, let's change it. This is a loophole, how can we fix that? Let's make those controls better. So you have to monitor it and constantly assess it. Once internal controls are set, doesn't mean it's set in stone. It can be changed. Monitoring often includes observing employee behavior, so you're looking to see, are they acting weird, are they doing things maybe they shouldn't be doing, are they going somewhere often that's weird. That may be a symbol or sign of employee fraud. So here are some warning signs of internal control problems. Abrupt changes in lifestyle without winning the lottery. If all of a sudden they have more money, where is this money coming from? Close social relationships to suppliers. Suppliers are giving the business things, well, maybe they're taking some of those things for themselves. Refusing to take a vacation. Part of that, not only being worn out and making mistakes, but if you take a vacation, somebody else comes into your job, into your position, and they can catch things that you've been doing that you're not supposed to. Frequent borrowing from other employees means you have bad money management, makes you a risk of theft and fraud. Excessive use or control of alcohol or drugs. These affect your decision making. They can also make you desperate for money, so that could be a sign. And then if we look at the accounting system, signs that something may be going wrong with internal control. You have missing documents or numbers aren't in order. That can mean that they're being used for fraudulent transactions. An unusual increase in customer refunds. You're refunding money to the customer, but no, not really. You're taking the money. Difference between cash receipts and bank deposits. Well, we took in $500 today. Why did we only deposit $300? Might be a sign of theft. Sudden increase in slow payments. So you have people not paying their bills back quickly, like we talked about accounts receivable, and they're not paying them back as quickly as they used to. Well, employees can be stealing that money and then hoping you don't catch it. Also, a backlog in recording transactions. You are behind in recording transactions so that it takes longer for people to catch that you're stealing money. So there are limitations. Internal control can't do everything. So there's the human element. The internal control is only as good as the people who are monitoring it, implementing it, and the management style and philosophy that is being demonstrated. Also, cost-benefit considerations. Internal control costs money. It costs money to have people do those systems, to buy the software to do it, to have the tracking, maybe have cameras, to be able to implement this internal control. Is the benefit worth the cost? You have to weigh that out, and you can do an analysis of that and say, okay, it's going to save us more money in fraud, theft, and employee dishonesty than it's going to cost us, so then it's worthwhile. So let's take a look. We've got three different elements that we talked about, internal controls, and we're going to say, are they relating to the control environment, risk assessment, or control procedures? Pause, take a second, see if you can figure out the answers. All right, let's see how you did. Mandatory vacations. That is part of control procedures. It's a procedure we set in to control how the access that people have to documents and control the fact that we'll let other people see those. Personnel policies, that's the control environment. It's the overall big picture. It's not one set of rules. It is a big of how do we deal with personnel in general. So control environment is more general. A procedure is more specific. Report of outside consultants on future market changes, that's risk assessment. We're looking to see what might happen in the market in the future so that we can be prepared for anything that might happen. So risk assessment is preparing for changes and differences. That concludes your lecture for today. Thank you.